Imagine you're a sailor preparing for your next big adventure. Instead of letting your boat sit idly at the dock, you rent it out to others in the meantime. Sure, it's just for a short bit, and the pay isn't exactly massive, but it's enough to keep the boat working for you until you're ready to set sail again. That's exactly how to think about your cash, keeping it accessible while still letting it earn enough extra for you to keep it relevant. In today's video, we're going to explore the 5 best ways to park your money for short-term investment. Whether you're saving for a down payment, funding a renovation, or simply waiting for the right opportunity to invest, these strategies will make sure your cash is working for you even in the short term. Number 1, high yield savings accounts. So these high yield savings accounts are basically the upgraded version of your standard savings account. Think of them as the savvy sibling to your checking account, which, let's be honest, usually pays nothing in interest. With a high yield savings account, the bank or credit union pays you regular interest on your balance. And here's the cool part, you don't need to do anything extra to earn it. So who are they good for? If you're someone who hates the idea of risk, and let's face it, who doesn't when it comes to their hard-earned cash? A high yield savings account might be the new best friend. It's perfect for those of you saving up for short-term goals like a down payment, a big trip, or even a rainy day emergency fund. The money is safe, insured, and ready when you need it. So what about the risks? Here's the thing, there really isn't much risk, especially in the short term. These accounts are insured by the FDIC if you're at a bank, or by the NCUA if you're at a credit union. So even if the bank goes belly up, your money is protected. You can watch my previous video on this to learn about how some banks can insure instead of the typical $250K up to millions. Now, if you park your money in one of these accounts for years, inflation might eat into your purchasing power. But for short-term goals, it's as safe as it gets. The rewards. Here's where it gets fun. Online banks usually offer much higher interest rates than the big name ones with brick and mortar. And you can access your cash easily. Most of these accounts let you transfer money back to your primary bank quickly, and some even come with ATM access. That's pretty cool. Just be careful though, because some banks charge fees for maintenance or ATM withdrawals. And honestly, you don't want those fees nibbling away at your interest earnings. So make sure you read the fine print. Liquidity. High yield savings accounts are super liquid. You can add money anytime and take it out when needed. Just remember that most banks limit you to 6 fee-free withdrawals or transfers per statement cycle. Although, thanks to a recent change from the Federal Reserve, some banks have started waiving this limit. Now, pro tip, do yourself a favor and comparison shop. It's incredibly easy to find out which online banks are offering the highest rates. I have a video I recently did on this. And setting up an account takes just a few minutes. By the way, I've already covered in another video a list of platforms that offer higher savings interest rates. So if you haven't yet, check that out and make sure to watch it when this video is over. It's packed with tips on how to boost your savings. But today, let's dive into a solid short-term strategy. So, if you're looking for a low-risk, high-convenience way to let your money earn more while keeping it very accessible, a high-yield savings account could be perfect for you. Now, let's move to the next option you might want to consider. Number 2, money market accounts. All right, so we've talked about high yield savings accounts, but another great option to park your cash is money market accounts. Think of these as like the middle ground between a regular savings account and an investment account. They typically offer higher interest rates than savings accounts, but there's a bit of a catch. Typically in a money market, you need a higher minimum balance to open or maintain it. So who's it good for? Well, money market accounts are great for people who need easy access to their money without jumping through hoops. Maybe you're saving for a short-term goal like a vacation or an emergency fund, but you still want to earn more interest than a typical savings account would offer. So what about the risks? The good news is that as long as you choose an FDIC insured money market account, your cash is good up to $250,000 per depositor per bank. That means you're not taking on any real risk of losing your money. Just check that FDIC label before signing up. The rewards. Here's the even better news. Money market accounts often give you a solid interest rate while keeping your money accessible. Need it in a pinch? No problem. You can typically transfer or withdraw funds extremely quick if something comes up. Plus, some accounts even come with check writing privileges or a debit card for added convenience. Just make sure you keep that card put away for what you intend it for. Now, liquidity. Like savings accounts, money markets are highly liquid. You can move your money in and out as you need, though federal regulations might put a limit of fee-free withdrawals per month. But honestly, unless you're constantly dipping into it, this isn't really a big deal. Now, where to get them? You can find money market accounts at most banks and credit unions. The key here is to shop around, compare rates, minimum balance requirements, and any fees to make sure you're getting the best deal for you. So, if you've got a little extra cash that you want to keep accessible and earning more than a regular savings account, a money market could be a great fit for you. Now let's keep this rolling. If this is helpful, I would really appreciate it if you smash the like and follow with your notifications turned on. You doing this helps this channel more than you can imagine in reaching and growing the impact. Now let's dive into number 3, baby! Next is short-term US government bonds, a super safe and reliable option for parking your cash. Think of these as the financial equivalent of loaning your money to Uncle Sam. They include things like T-bills, T-bonds, T-notes, and even mortgage-backed securities from federal agencies like Ginnie Mae. So who's this good for? Well, these funds are perfect for anyone who's super risk adverse and wants to keep their money as safe as humanly possible. If the idea of analyzing individual bonds sounds like a headache, this is a great way to diversify without all the extra work. Now, what about the risks? Here's the deal. Bonds issued by the federal government and its agencies aren't FDIC insured like savings accounts, but they're backed by the full faith and credit of the US government, which basically means you getting paid, baby. Your even better short-term bond funds are less affected by interest rate changes than long-term ones. So whether rates are rising or falling, the value of these bonds stay relatively stable. The rewards. Government bond funds won't make you rich overnight or ever, but they're reliable. You'll earn a steady rate of interest, and while the returns aren't going to be as high as a corporate bond, the trade-off is that you're taking way less risk. Liquidity. Here's another win. Government bonds are highly liquid. These are some of the most widely traded assets in the world, so you can buy or sell them on any day at any time that the market's open. Need to cash out? No problem. It's quick and easy. Where to get them? If this sounds like the right fit for your short-term cash, you can pick them up at pretty much any online broker that offers ETFs or mutual funds. It's really that simple. So if you're looking for a low-risk, highly liquid option for your money, short-term US government bond funds could be a smart move. Now, let's keep this momentum moving and dive into the next strategy you're gonna wanna know. Number 4. Cash management accounts, baby. This is a super flexible option for managing your short-term cash. Think of these as hybrid between a savings account and an investment account, giving you the best of both worlds. See, they let you park your money in a mix of short-term investments while still acting like a bank account for your everyday needs. So who's this good for? Well, if you want a liquid account that gives you quick access to your money and maybe even pays some interest, a cash management account could be a solid choice. It's perfect for anyone looking for flexibility without locking up your funds. Now, what about the risk? Well, the risk here is pretty minimal. Most cash management accounts invest in very low risk money market funds, and some accounts even deposit your money into FDIC protected partner banks. That means your funds are insured up to $250,000 per depositor per bank. Now, one thing to keep in mind though, if you're using one of these accounts through a robo-advisor or broker, check to see if they're partnering with a bank where you already have deposits, because you don't want to exceed your FDIC coverage limits of $250,000 or whatever the bank has. The rewards. The big draw here is flexibility. With a cash management account, you can invest, write checks, transfer money, and do other banking activities, all from the same single account. It's like having a Swiss Army knife for all your finances. Liquidity. Cash management accounts are extremely liquid, which is a huge plus. So you can withdraw your money anytime, and unlike traditional savings or money market accounts, there's usually no limit on monthly withdrawals. So it's a little bit more user-friendly in that sense. Where do you get them? Well, you'll typically find these accounts offered by robo-advisors and online stockbrokers. They're super easy to set up, and many of them even integrate seamlessly with your existing financial accounts. So if you're looking for a versatile, low-risk place to park your cash, cash management accounts are definitely worth considering. Now, let's move on to the next option. Number 5, money market mutual funds. You like that, robot? But first, don't confuse these with money market accounts. This has a mutual fund on it. They sound similar, but they come with some differences, okay, in terms of risk and structure. Think of money market mutual funds as a way to earn a little more yield on your cash by investing in short-term securities like treasuries, municipal and corporate debt, or even debt-banked securities. All that means you're giving money to get loaned out at some risk. So who's this good for? Well, if you want easy access to your cash while earning some yield, money market mutual funds could be a great fit, okay? They're ideal for someone who does not want their money just sitting idle, but also doesn't want to take a ton of risk. So what about the risks? Well, here's the deal. While money market mutual funds are generally safe, they're not as rock solid as a money market account, which is FDIC backed. Okay, so in rare cases like during severe market upheaval, these funds can lose value. But most of the time, in normal conditions, they're super safe, conservative, and designed to protect your principal. The rewards. The main appeal here is the yield. You'll typically earn a steady return on your investment without much fluctuation in the principal. So it's a low-risk way to put your money to work while keeping it relatively safe. Liquidity. Now, money market mutual funds are pretty liquid, so you can access your money when you need it. Some funds even let you write checks directly from the account, though you might be limited with 6 withdrawals per month. But if you're doing more than 6 withdrawals a month, maybe you're not saving this money for a rainy day. Just saying. So if you're planning to make frequent transactions, keep an eye on those limits. All right, now where do you get these? Now, if this sounds like a good fit for your financial goals, you can snag money market mutual funds through brokers that offer mutual funds. Just remember to check the expense ratio. Since this is a mutual fund, you'll be paying a small fee for the fund management, and a reason why I personally am not a huge fan of this. However, if you're looking for a slightly higher yield than a savings account, but still want to keep things conservative, money market mutual funds could be worth exploring. Now, here's a fist bump from me to you. Be sure to grab my free, as of right now, limited time free money and crypto masterclass. There's a lot going on in this world, people. And I put this together and I'm offering it for free as my gift to you. There's no hooks, there's no gimmicks. Just grab it down below. And as always, smashing that like. If this video added value to you, please smash that like. Even share this with a friend. Subscribe, notifications turned on. You have truly no idea with the algorithms how much this helps. So thank you for watching to the end, smashing that like, grab that course, and I will see you, my friend, on the next video. Always, you keep living your life to the fullest, baby. Peace.